Hey, this is Sasha, and welcome to another episode here on Let's Talk Stocks. Now, today what we're going to do is talk about rights and obligations when it comes to options. So if you've been a little worried about, hey, am I going to get this stock assigned to me? What are the legalities? What are the legal implications about trading these options? They always talk about rights and obligations. You have the right to, but you're not obligated to. What does it all mean? I'm going to simplify it for you. So let's first get to the screen so that way you really know and understand what we're talking about. Before we get there, I'm going to use a Groupon example. So if you don't know what Groupon is, basically a Groupon is, if I go ahead and look up some food over here in Tampa, Florida, it's basically, what happens is you go ahead and you buy something like this Groupon, or in other words, a coupon. So if I want to go to Gio's Italian restaurants, you pay $15 and you get $30 worth of Italian cuisine. And usually you have to buy this, within a day, a couple days, and it expires within 365 days of purchase. So think of it like there's a time value involved there. So anyways, that's basically the way that Groupon works. And if we go to the paper, here's what I want to share with you when it comes to trading options. Because when you look at the option rights, you got to understand this concept. You have two parts to it. You have the calls and you have the puts. Now, in there, you could be a buyer or you could be a seller. Now, on the put side, you could be a buyer and you could be a seller. So there's four types of, legalities when it comes to options. And when we look at this in terms of a Groupon, let me simplify it for you. So looking at it, hey, here's a Groupon. How does it really work? Well, I go ahead and let's say there's two parts here as well. You got a buyer and you got a seller. Okay, so if I go in and I want to go ahead and buy this Italian cuisine, I want to go in and I want to get this coupon. Well, it cost me $15 for the coupon, but then I get $30 worth of food when I'm ready to go ahead and use it, as long as I use it within 365 days. Okay, so basically as a buyer, you can go ahead and buy it for $15. You buy that coupon, but you get $30 worth of food. As a seller, this is the business owner, they have to provide, or give me food. Okay, so that's the way that it works. So how does this apply to stocks? Well, or options? Well, as a buyer, when you buy a call, you go ahead and you pay money. Okay, so now when you pay money, you have the right to buy or get the stock, right? Now, are you obligated to go ahead and spend your coupon? Are you obligated to go ahead and go to that Italian restaurant? Do you have to? No, you don't have to. So do you have to go ahead and buy the stock if you're a buyer of a call option? No, you don't have to. You can, you have the right to, but you don't have to. So you're not obligated to, but you have the right to get that stock as long as those requirements are met in here. Okay, so if it's let's just say 175 call option that you bought, it expires in 365 days on a certain stock, let's say Netflix. Well, as long as that hit, and you're a buyer, then you have the right to get that stock if you want. Now, most people don't. They just go ahead and just sell their option contract for more money. But you could. If you wanted to, you could. Now, on the other side, the seller, let's look at it from the selling side. If you're a seller, if you're a business owner, because you could be a seller of option premium as here, just like if you're on Groupon, well, you could actually be a seller. If you're a business owner, you could go ahead and sell things. Well, here, they're obligated, right? So obligated to get you the stock at that price. So if the stock now is trading at $205, well, they have to get it at $205 and give it to you at $175, right? Because that's what you bought that call option for. So that's the way that it works. And on the put side, it works very, very similar. So it's the same concept. It's just when you look at it on a Groupon side, there's no puts in there. So the way that you would think about this on the Groupon side is, okay, buyer and seller, this Groupon, this is for Italian food. This Groupon, number 2, this is for, let's say, sushi. Okay, so think of puts as sushi. So it's the same concept. You got a buyer and you got a seller, and it's the same approach. Well, okay, well, now it's maybe $20 and you get $40 of food. Same concept, right? So if you're a buyer, what does that mean? Well, if a buyer of put, remember, if you buy a put, you're looking for stocks to go down. If you're a buyer of a put, you can put that stock to someone. Put the stock to someone. So you have the right, okay, because what is it giving you? The right for sushi. So here in this case, you have the right to put or sell the stock at a price. But do you have to? Do you have to go get sushi? No, you don't have to go get sushi. You could if you want to. It gives you the right here, but you don't have to. And as a seller, well, now you're basically obligated, or in other words, if that stock is put to you, right, you're forced. F-O-R-C. Okay, so looking at it on a profit picture, I think that's a simple approach to do this. So let's just go real quick on the Thinkorswim platform, and I'll just show you Netflix right now is at 365. So let's say I go ahead and just bring this down, and I'm going to go ahead and buy a single. So buy a call. Yes, it is 4 a.m. in the morning. So if I go ahead and buy a single, so you can see right here, I can go ahead and here's my profit picture. I make money as stock goes up. So in this case, I have the right to go ahead and buy it if I want to at that 390, but I'm not obligated to. I could just go ahead and cash out as this becomes more valuable. If I go ahead and sell it, what does it look like? Well, now, I lose money as it goes to the upside, right? Because it's opposite of the buying side. If I do a put, how does that work? Well, let's do a put. Let's say we got a 320 put, and I go ahead and I'm a buyer of it. Well, if you buy a put, you make money as stocks go down, right? So in this case, you're profitable. And if you're a seller of a put, well, you lose money as stocks go down because now you're forced, right? You could be assigned the obligation. So now what happens is you're losing money. So you have to get that the stock might be put to you. So anyways, if you've never seen these profit pictures before, basically this is the profit and loss. This is the stock price over here. And this is what you're making, right? As stock goes up and down. This is what they look like. But really, you know, if you're a buyer of a call, you're looking for stocks to go up. If you're a buyer of a put, you're looking for stocks to go down. Rights versus obligations. Well, here you got a right. Okay, you don't have to do it. On the put side, you got a right. You got a choice to protect yourself if a stock goes down. You can give it to somebody else, but you don't have to. If you're on the sell side, you basically have the opposite effect. Okay, so take a look at this right here. Okay, that's really a detailed version of it for you in a simple manner to explain it. That really what you're dealing with is a buyer, you have the rights, but you're not obligated. As a seller, you know, here of a call, well, you got to get that stock to somebody if something is met. If you sold an option at 175, well, you got to get it to them at 175 if it goes against you. If on the put side, the buyer has the right to put that stock to you if you sell a put, right? If I sell a put at 150, well, someone can put that stock to me at 150 even if that stock goes down to 100 because they've bought that right, right? They've bought the right. So anyways, I hope that gives you a little more insight into rights and obligations and really what it means. The main thing is you got to worry about this more if you're a seller of options and then if it goes against you. And if you're doing spreads, remember you're protecting yourself. So the risk is even a little bit different, I guess you could say, more hedged. So hopefully this was helpful. If not, feel free to reach out on our website at tradersfly.com. I'll go ahead and explain it to you further, or you can go ahead and ask a direct question. Even there, submit one by voice on our podcast and show. And feel free to go ahead, subscribe to our YouTube channel, or join me on the newsletter list by clicking the links over here. Thanks again, and I will see you next time.